On May 22, 2026, Kevin Warsh was sworn in as the 17th chair of the Federal Reserve, officially inheriting a $39 trillion national debt. It is a staggering, historically unprecedented number. To manage a liability this massive, the US government is quietly preparing a strategy known as financial repression. This isn't a new theory, it's the exact same monetary policy used between 1942 and 1951 to wipe out a mountain of World War II debt. They did it by legally capping interest rates well below the rate of inflation. Think of financial repression like a casino slowly changing the rules while you're still sitting at the table. Instead of forcing you to pay a tax at the door, the house quietly adjusts the payout odds over time. Your winnings never quite match the rising cost of the chips. In the real economy, the government suppresses interest rates on savings accounts and bonds well below inflation. This silently drains purchasing power from your bank account directly to the state, allowing them to liquidate massive debts without ever passing a highly unpopular tax hike. The arithmetic of a $39 trillion debt spiral isn't just a problem for American taxpayers anymore. It's a structural deficit that traps the entire global financial system. Look at standard interest rate projections. Congressional modeling pushes federal net interest spending up to a staggering 6.2% of gross domestic product by the year 2049. That is an overwhelming slice of economic output dedicated solely to paying off past debts, leaving almost nothing for future innovation or infrastructure. And the trajectory only gets steeper. Under those exact same scenarios, the long-term federal deficit is projected to hit 9% of GDP by 2049. To sustain this system, the United States desperately needs buyers. It requires a constant, endless stream of foreign capital, and the international markets have complied. Total foreign holdings of US securities rebounded with incredible force, hitting $26.9 trillion by mid-2023. The concentration of this capital is massive. European holdings of US securities alone broke past the $10 trillion mark during that same reporting period. But the true scale of the situation becomes clear when you look at the specific nations locked inside this financial cage. As of the official Treasury reporting in mid-2023, the Bank of Japan holds $1.021 trillion in long-term US Treasuries, making their domestic economy highly vulnerable to American policy shifts. Just across the sea, mainland China holds another $692 billion, while the United Kingdom owns an additional $498 billion in these assets. These central banks cannot simply dump these securities overnight. Doing so would instantly collapse the value of the foreign reserves they depend on to stabilize their own currencies and global trade. This creates an inescapable global hostage crisis. Foreign allies and economic rivals are forced to continually buy American debt, simply to prevent a catastrophic collapse of the dollar-based financial order. Look across broader asset types. Canada has $1.458 trillion in total exposure to the US financial system. That position is mirrored by the United Kingdom's $1.457 trillion, while Japan holds an additional $837 billion in broader assets. For these allied nations, buying American paper isn't an optional investment to chase yield, it is an economic defense pact. They are forced to finance American spending just to keep global trade moving. Even smaller and mid-sized economies are caught in this same gravitational pull. Look at Belgium, the hub of European clearinghouses, holding $980 billion in US securities. Down in the Southern Hemisphere, Australia backs its economy with $571 billion, while Brazil handles its volatile currency by holding $246 billion in US debt. These nations use American Treasury bills as safe haven collateral. Yet, they are locked in a cycle where the very asset protecting their balance sheets is being intentionally devalued by the Federal Reserve to manage American debts. The playbook for wiping out this level of debt was written and executed decades ago. After the Second World War, the US debt to GDP ratio fell sharply from its peak near 120%. This debt reduction didn't come from sudden economic growth or extreme spending cuts. It came from a coordinated campaign of financial repression. Following the landmark 1951 Treasury Fed Accord, Average returns on 3-month Treasury bills hovered near zero. The Federal Reserve enforced a strict peg, capping short-term T-bills at just 0.375%, locking bondholders into a losing asset while post-war inflation ran hot. Now, cut back to the modern era. The political pressure to recreate this exact environment has reached a boiling point. In late January 2026, the administration took unprecedented steps, testing the boundaries of Federal Reserve independence by publicly demanding lower rates and initiating political reviews of current board governors, specifically targeting figures like Lisa Cook. These executive maneuvers cleared the path for Kevin Warsh to join the Federal Reserve Board, setting the stage for him to inherit the chairman's gavel from his predecessor. Historically, Warsh had a reputation as a strict inflation hawk, but his tone softened dramatically in the months before his nomination. He recently told the press that his new preferred gauge of US inflation is actually one of the lowest readings available. This shift was a complete departure from his normal stance. It signaled to Wall Street that he was ready to support a highly accommodative, low-rate approach. But how does a modern central banker justify cutting interest rates while inflation stays high? They have to introduce a new narrative to the markets. Warsh began pushing a supply-side theory centered on artificial intelligence, calling it the biggest productivity wave of our lifetimes. In Warsh's view, widespread AI deployment will multiply economic output, allowing the central bank to cut interest rates without the risk of reigniting inflation. This theory hinges on a concept known as the long-run neutral interest rate. Imagine you are driving a heavy, fully loaded freight truck on a straight highway. The long-run neutral interest rate is the pressure you need on the gas pedal to keep the truck cruising at the speed limit, not accelerating out of control and not slowing to a crawl. Now, if an engineering breakthrough suddenly makes your engine more powerful and your car go weightless, you don't need to press the pedal as hard to stay at that speed. Warsh is arguing that because artificial intelligence is upgrading the economy's engine, the Federal Reserve can ease off the brake without crashing the system. However, the economic dashboard is flashing bright red. The real-time data completely contradicts this tech-driven optimism. Even though the president and the new Fed chair are publicly calling for deep rate cuts, the US economy is already at full employment. These demands are inconsistent with basic economic models and have almost no historical support. Following weeks of geopolitical instability and war in Iran, incoming inflation data delivered a harsh reality check. The April 2026 Consumer Price Index showed inflation rising to 3.8% year-over-year, while the March Personal Consumption Expenditures report hit 3.5%. Both metrics sit dangerously above the Federal Reserve's 2.0% mandate. The missing link in Warsh's AI thesis is a metric known as total factor productivity, or TFP. Think of a busy coffee shop. If you buy 3 new espresso machines and hire 3 new baristas, you sell more coffee. That's just standard growth from spending capital. But total factor productivity is what happens when an employee invents a new brewing method that lets your existing baristas, using the exact same machines, suddenly produce twice as much coffee in half the time. It is the magic of true innovation. And right now, that magic is completely absent from the data. As of May 2026, official Bureau of Labor Statistics data shows year-over-year total factor productivity growth stalling at just 0.8%, while standard labor productivity sits at 2.5%. The AI productivity boom is a statistical ghost. If the Federal Reserve gives in to executive pressure and cuts rates prematurely based on phantom AI gains, the global economy risks entering a brutal cycle of stagflation. For the average citizen, this means a sharp rise in the daily cost of living, while wages and jobs vanish. This gap between political narrative and economic reality sets up a massive policy collision. Outgoing Fed Chair Jerome Powell aggressively defended the dollar's purchasing power, leaving the US policy rate 225 basis points higher than when he started. He moved the benchmark from 1.50% to 3.75%. Powell adjusted policy in nearly 40% of his official meetings, creating one of the tightest monetary environments of the century. Under Powell, US rates ran roughly 50 basis points higher than Canada's on average, projecting strength across the global bond market. To see how abnormal the demand for immediate rate cuts is, zoom out and look at the long-term historical yield curve. The 30-year Treasury yield has been trapped in a multi-decade decline, dropping from 8.43% back in June of 1990 down to the compressed levels we see today. We're sitting at the absolute bottom of a multi-generational debt supercycle. Warsh's proposed strategy, a liquidity gambit, involves trying to shrink the Fed's balance sheet while cutting interest rates at the same time. But this dangerous maneuver risks triggering what traders call a liquidity structural paradox. Draining the balance sheet to satisfy inflation, Hawke slowly starves the overnight repo market of the cash needed to keep global financial plumbing operational. If pushed too far, it risks a catastrophic freeze, just like the chaotic repo market blowout in late 2019. To navigate this dangerous transition without causing public panic, the government has to quietly manage the optics of inflation. They do this through mechanics known as substitution bias and hedonic adjustments. This isn't a conspiracy theory, it's the mechanical reality of how the government calculates your cost of living. When the price of premium beef skyrockets, the official inflation basket assumes you will substitute it with cheaper chicken or pork, artificially lowering the reported cost of living. At the same time, hedonic adjustments calculate that because your new smartphone has a better camera and faster processor, you are receiving more value for your money. The government uses this perceived value to suppress the official inflation reading, even as your actual out-of-pocket expenses surge to record highs. This manipulation creates a devastating phenomenon known as demographic velocity divergence. This policy permanently separates the generations financially. Cash-heavy boomers on fixed incomes see their savings and purchasing power quietly eaten away by these synthetic inflation metrics. Meanwhile, asset-holding millennials and institutional investors ride a massive wave of artificially inflated stocks and real estate. It is a massive, silent wealth transfer, executed not through taxes but through central bank policy. So where does this leave you? How do you navigate a decade defined by financial repression, synthetic inflation data, and suppressed interest rates? The preservation blueprint for 2026 and beyond is clear. You have to pivot away from large cash allocations and low-yielding government debt. The smartest institutional money is already moving into hard assets, cash-flowing stocks, and commodities. Assets that have the scarcity needed to absorb endless monetary expansion. In an era where fiat currency is being used as a pressure valve to slowly deflate government debt, owning the underlying, tangible infrastructure of the economy isn't just an aggressive growth strategy. It is the ultimate financial defense. Don't be the player sitting at the casino table, holding onto cash chips, while the house quietly changes the value of your winnings. Step outside the casino entirely. Own the real estate, own the energy, own the businesses that write the rules, because the era of financial repression has officially returned. And this time, the only way to win is to own the board.